Hello and welcome to the Assay. Today I am pleased to be joined by Julian Babarczy, founder and chief investment officer at Jigsaw Investments. So Julian, thanks for joining us here at the Assay again.
No problem, Amy. It's really nice to be able to talk to you. Look forward to sharing some thoughts.
Sounds great. It's always really nice to catch up, especially if we haven't been over in Australia for a while. But so just to kind of kick it off, you've had a very long career in the industry covering both the investment and the corporate leadership side of things. So can you catch us up on kind of where your current focus is right now?
Yeah, sure, Amy. I left the funds management industry about 5 years ago. So I spent about 15 years at a fund in Sydney for a lot of time covering predominantly natural resources and some other sectors. And what I found over that journey was that, it was a very exciting time growing a fund. But by virtue of being at a fund, you have many positions, but probably don't know the depth on each of those that ultimately I wanted to get deeper into certain situations. So since leaving that fund, I set up Jigsaw Investments with really the view to get much more hands-on and more active with a bunch of different companies. So there's varying degrees of involvement. I've got some relatively passive investments and some which I'm effectively running. So right through the spectrum, if you like, and some earlier stage companies as well as some later stage companies. But there's a number of those in the mining and critical mineral space, which is probably somewhat of a passion of mine. I've been a believer in the critical mineral space for quite some time and have tilted my portfolio towards that. So really, what I've been doing since is getting more hands-on in helping to grow and run these companies, and ultimately, hopefully build some substantial sized companies on the back of good assets with good management teams, and then over time, get less involved and become more of a passive investor and move on to the next one.
Sounds great. And I definitely want to get into kind of the critical mineral side of things in a bit. But, just kind of as an overview, what do you see are some of the biggest risks and impacts on the metals and mining industry today? And, we've got geopolitics playing a massive role right now. What do you see happening?
Well, probably the biggest risk that always underlies investing in the minerals and mining space is the price volatility of the commodities. That's a given. I guess we probably don't have to spend too much time at it, but that's always going to be the determinant of a very large part of any move in the value of a company. So that's something you have to have a view on, I think, if you're going to invest in the space or have a investment time horizon that really is long term, so 3 to 5 years plus, understanding that there'll be various cycles within that. So price volatility is pretty big. Inflation's been a big theme throughout the globe over the last 5 years as well. We've had rates go up trying to tackle inflation. That's definitely been a big impact to the mining industry as well. Cost inflation is pretty constant in the mining space, tends to push cost curves up, which tends to impact commodity prices over time because the marginal price or the marginal tonne tends to come out at a higher and higher price over time. And so cost inflation is a real thematic. And then, look, you mentioned before geopolitics. That's absolutely real. Supply chain disruption, supply chain onshoring, certainty of supply chains. These are some of the big things that are really probably some of the biggest thematics at the moment. Just stepping back, when the Biden administration came in 2020, they determined that we wanted a lot of clean energy, and that meant that the globe was going to be more reliant on the supply chains that were in place at the moment. Unsurprisingly, China's been very active in building that supply, particularly out of China, but also in other parts of the world. And then with Trump coming in, there's been a real change in sentiment there. There's been a shift towards wanting to onshore or have security of supply outside of some of these China supply chains, just in the off event that there's some trade imbalances that mean that China may turn the tap off on their exports for periods of time. And so I think more recently you've seen a big desire for people to have supply chains that don't touch Asia or China and are more linked to the US, for example, and that's distorting some markets and creating opportunities in others. So there's a lot more capital chasing opportunities that are more purely US style supply chains. And so, yeah, look, it's a very interesting time. But probably no more interesting than other times. There's always things to worry about and always pressures hitting industries, but they're probably the main ones at the moment.
Absolutely. And, just on those, with Trump's kind of coming in and his new focus on those kind of regionalizing supply chains, that really is impacting the critical mineral space, particularly. That's kind of one of his big focuses at the moment. So, what do you see as being the impact on those markets?
Yeah, well, it's interesting because I think when Trump came in, everyone thought, which he did do, he would focus more on the hydrocarbon industry and resuscitating that with US onshore oil production. And he's definitely done that. He's taken away, or has talked about taking away EV mandates and those sort of things, which have been probably at the margin assisting the US side of critical minerals demand for the batteries that are required. But I think his actions have also suggested that they're very keen to stimulate more critical minerals into the US as well. And I think the first order effect was people thought it was going to be quite negative for critical minerals, but now we're seeing actions from the US government, like the Department of Energy underwriting supply from MP Materials rare earth production just recent as last week at very high prices to incentivize supply into the market. So I think what we're seeing now is, I guess, the second order effects of Trump's administration. Initially, it was probably quite negative, and it's coming through, I guess, as much more positive now. At the same time, I think you've seen a general slowdown in supply response. There was huge supply response in some of these commodities, particularly lithium, a number of years ago. That overwhelmed what was a relatively small market at the time, and I think we've seen a lot of very rational supply get taken out of the market, so the higher cost tons have come out, and that's been going on for some time, and I think we're seeing a rebalance now. Lithium, for example, is going through somewhat of a mini renaissance at the moment, which I think for those of us who've been waiting for the turn, it's quite heartening to see. It did feel like everyone was on the momentum trade. There was a lot of shorts in some of the listed companies betting that supply would continue to keep prices low. But I think they've gotten to a point where they were probably far too low, and even the decent production volume in the market at the lower end of the cost curve was struggling to make much profit. And so I think what we're seeing now is a natural normalisation. And I think an environment where good quality mines can actually attract capital and can grow and can do brownfields expansion, etc. And so look, I think it's a relatively positive outlook now for a lot more commodities, much more positive than it was even 6 or 12 months ago.
Absolutely. And I mean, let's talk about kind of bringing that capital into the market. So do you see money or investment going into the critical minerals space in order to kind of help grow the supply of these much needed minerals?
Yeah, well, the fact is it does need to happen. And without it, you just won't get much supply response. I guess one of the issues the industry has faced is that the harsh reality is critical minerals tend to be industrial minerals. So the product specifications are quite diverse on what different customers want. And what that means is that there's no standardization of indexes or pricing. And so it's a very opaque market. And in an opaque market, it's very hard for bankers and others to fund projects because they're not quite sure of the detail of the product that companies are selling. Because there's no exchange traded commodities as well in the critical mineral space, it also makes it more challenging to do forward sales and other techniques that often de-risk capital coming into an industry. And so what that's meant is that there's been much more confusion and price volatility than what most people would expect. That means that the industry's had to step in and fund. So you've needed people within the supply chain to write offtakes at relatively good levels. You've also required that often they've had to prepay some of those offtake funding arrangements to allow companies to attract other equity capital. So it's just been a much more complicated funding process. So I think as the industry matures, you'll hopefully get more standardization in pricing, more visible indexes which have decent liquidity so people can rely on the prices. And that, I think, will embolden investors to both initially with equity to get behind some of those commodities a bit more, and ultimately the banks to be able to fund and provide debt, which is typically a valid source of capital as well for these. Policy stability is another area that probably needs a little bit of work. And again, these are young commodity markets. They're very small niche commodity markets in some instances as well. And the policy impact is extreme at the moment. And so I think as these mature and as policy matures, I think you'll get a much more benign environment with less volatility that, again, will make capital much easier to come into a sector and stay there for periods of time. Because I think a lot of more traditional investors look at some of these niche commodities and they just get frightened at the volatility around some of the indexes that they're either investing in or the companies themselves. And then, look, the last aspect that probably needs to be seen to get more people back in is probably the industry itself assisting with making it easier for some of these projects to get funded. And what I mean by that is I think everyone seems to want supply sources for critical minerals that are outside the China supply chain. And that makes sense because it's security supply and that sort of thing. But the problem with the customers is they typically want to pay the prevailing Chinese price, which in many respects is too low to incentivize the supply outside of China. So I think what we need to see is the industry being a bit more mature and writing contracts for new production that is maybe above the spot price, trying to incentivize supply, and that will ensure that there's additional tons coming from supply chains that going forward are probably what is needed. So it's a multifaceted approach, just around giving greater confidence to both debt and equity investors to be able to take a longer duration bet on some of these commodities.
Absolutely. I mean, it's interesting. You talk about kind of, de-risking investments, de-risking, projects for investors. What is the potential for this? How can kind of investors be a little bit more sure about where they're putting their money?
Yeah, well, that's always the difficult thing. There's protections for people in the listed space with the JORC code, and in America the NA 43101 code, which are quite prescriptive on the rules around how companies announce results, etc., and that gives some protection. But overall, really comes down to investors likely looking for higher asset quality, because if you're unsure or it's a sector you don't know too intimately, then asset quality is typically best. And so ideally what you're having is higher grades, because that typically leads to lower cost production, which gives you a larger buffer to weather any price volatility. So asset quality is very high. For listed companies, commodity mix is key. We all like to stay very pure and trying to just develop good projects in any commodity at through the cycle prices. But the harsh reality is that investment markets tend to crowd into what's a bit hotter at that time and than what isn't. And so attracting capital through the cycle means that often you have to either be a bit lucky and be in the right commodity at the right price and get your project funded at that point, or have a multi-commodity approach. That's what some of my companies have taken, having a number of different shots on goal, for want of a better term, and then therefore being able to fund yourself through the cycle, but keep moving forward on all projects, because often it's better to be doing things at the bottom of the cycle so that you're in a position to capitalise when markets turn. And we're seeing that in some of my companies, for example, in lithium, investing right through the bottom of the cycle. And now we're seeing much more interest now that we've got projects that are coming to fruition at a time when there's renewed interest. I guess other aspects are just strong management teams and strong boards with history and experience in managing companies through cycles, companies with good and frugal cost bases so they can weather downturns, and companies that take the right actions to reduce costs during downturns, rather than just keep diluting investors. So it's really looking for that mix of asset quality, commodity mix, and strong management that really helps. And ultimately that will lead to capital being able to be raised, because that is the lifeblood of small mining companies who aren't in production yet. The oxygen, for want of a better term, is the capital or the cash. And so having a good cash balance or the ability to raise capital is crucial.
Yeah, absolutely. And so, I mean, let's shift and look specifically at the ASX market. So how are ASX listed juniors faring right now in terms of investment? So, is the money coming in, and where is it generally going?
I wouldn't say it's easy at the moment, unless you're a gold producer, of course. Gold's a very hot commodity for obvious reasons. All the geopolitical risks and the devaluation of the US dollar, etc., suggest that gold's going to stay relatively robust. And I think we're seeing a relative ease in raising capital for gold companies, and I think that's likely to continue. There is green shoots, though, in other areas of the market as well. I mentioned before lithium and other critical minerals. There has been a genuine downturn in those for a couple of years. And so I think we're seeing that turn because there has been a supply response. Supply has been taken out of the market. I think stockpiles have run down in many respects as well. And in the background, you've just seen very solid demand just chugging away in the background. And critical minerals, that's one of the reasons I'm quite attracted to that space, is despite all the hype, the demand profile is still very strong, often in some cases growing anywhere between 5 and 15% per annum. And it doesn't take many years for that to grow into much larger numbers of incremental supply that's needed. And so I think we're seeing now that the pricing reductions or the commodity price reductions has led to not enough supply coming on, and so there's a genuine shortage, and so people in some markets are starting to scramble for supply. So look, it's improving, and I think investors are reacting to that, and they're starting to get behind some of the critical mineral areas in particular that haven't been as focused. I would say one of the hallmarks of the market at the moment is a lot of niche commodities are really having their day in the sun. And some examples there are things like antimony. I don't think many investors knew what that was a couple of years ago, and now we've got a number of very small niche companies on the ASX that are have got relatively decent valuations because these are commodities that everyone presumed they could get when they needed, but China's now restricted supply, and all of a sudden there's a shortage. And so there's a real chase to get hold of some of the companies who are operating in these areas. Another area is cesium. One of my companies, Perpetual, has got some interesting cesium shows over at its Brazil project. And these, again, is a commodity that the market knew very little of. So I guess at times the market swings towards backing the very well-known bulk commodities or the exchange-traded commodities, but it does feel like a more of a niche commodity focus at the moment. Although I would say the copper is another one where there's a genuine wide-held belief that the copper price is going to remain strong and probably keep going higher. And as a result, there's very few ways to play that on the ASX. And so copper exploration and development companies seem to be getting a lot of attention as well.
Yeah, absolutely. I think copper was kind of one of the main standouts from the discussions that we had at some of the events that we were holding in the first half of the year. It was definitely kind of a lot of focus on that. And so just to wrap it up, what would be your outlook for the next 12 to 24 months in terms of the commodities markets? Where do you think, what do you think the industry should be on the lookout for?
Well, just at a very high level and thematic level, I think the commodity sector is underappreciated relative to other parts of the market. I think we're all well aware of the big six in America, these tech companies that are trading at all-time highs with valuations. Now, they're brilliant companies, but it's just a valuation argument. Some of them are trading at multiples that just don't appear sustainable. At the same time, you've seen the complete opposite happening in the commodity markets. So the rubber band does feel very stretched in as much as commodities and commodity stocks are grossly underowned. And some of these big tech companies are probably grossly overowned. And typically that you get reversals at points in time. And so I would expect that the incremental dollar is probably going to flow into commodities. And so the outlook over the next year or two is likely to be much better than the last couple of years and quite supportive of investing. At the same time, as you're seeing now, commodity prices bottom out and go higher. Some copper, for example, is starting to make highs. The gold price is strong. Lithium starting to bounce. So we're still seeing some real green shoots. But I guess the thing I would say, it's going to be volatile. We all know that. That's the hallmark of commodities. So no matter what we think, there'll be some mini cycles within all that as well. Other themes I think will be quite important are M&A. I think we'll see more of that in the coming year or two, particularly as commodity markets improve. The strong companies will probably re-rate faster, and that will create opportunities for them to use their relatively overpriced scrip to buy underperforming assets or underperforming companies or companies that haven't re-rated yet. So I think M&A will be a key thematic of the next cycle. Again, there's a lot of companies I think that lack capital. And so those that with access to capital should be taking advantage of that. And then the other theme is just the ongoing policy shifts we'll see around critical minerals, around supply chains, which I think will buffet the sector positively and negatively at times. But overall, I think there'll be a strong tailwind to the sector after a number of years of probably pretty strong headwinds. So relatively optimistic outlook from my point of view, and look forward to what the next couple of years brings.
Excellent. Well, it's always nice to end on a positive note for the industry. But yeah, I mean, we'll definitely have to check back in with you over the next coming months and see, how things have shifted. But those were all the questions that I had for you today, Julian. So I want to thank you for joining us here at the Assay.
It's a pleasure, Amy. Nice to talk to you and look forward to talking again.
Yes, absolutely. Speak to you soon. Right.